Well, hello, everyone. Cynthia Tomane with Interactive Brokers, and thank you for joining today's webinar on an introduction to candlestick reversal signals. I'm very pleased to have with us today Jerry D'Ambrosio, Senior Instructor at VectorVest, to deliver today's presentation. So with that, let me move this over to Jerry. I'm going to pass you the controls. If you can go ahead and share your screen, we'll get underway here today. Thanks
Wonderful.
for joining us, Jerry.
Thank you very much, Cynthia. Hello, everybody. Let me just get the technology straight on my end. It looks like everybody can see my screen now. If you guys just don't mind typing in Y or yes, I can see your screen, it should say Introduction to Candlestick Reversal Signals. If it does, if you can see that, there we go. Grant, Dan, Suresh, Elaine, Tony, awesome.
And looks good from my end, too.
Awesome.
Thanks, Jerry.
All right. Well, great, guys. Glad to be back with you guys. I don't know if you've joined any of our previous webinars. I've enjoyed doing them. So if you have joined them, and hope you got something out of it. Now, I hope this is the first of many webinars that we do on this particular topic, Introduction to Candlestick Reversal Signals. There are dozens of candlestick reversal signals. We're going to touch on a few here today, but I really hope that this is the beginning of a series, and we bring more of this type of content to you moving forward. So let's first kind of just go over what are candlesticks. Candlesticks are highly visual price bars that illustrate the psychology between bulls and bears, between buyers and sellers. And it's really important to recognize where a stock closes compared to its low and or high, where it opens compared to those prices as well. So they give you an indication on basically winners and losers, right? Who won on any given trading day? Did the bulls win? Did the bears win? Was it a down day? Was it an up day? How strong of a down day was it? Did the stock price close at the low of the session, which would indicate bulls had a stranglehold? I'm sorry, bears had a stranglehold on the day, right? So when you look at a candlestick, and in a moment, I'm going to show you guys, because a lot of you might not be VectorVest subscribers. I'm going to be showing you the VectorVest tool and some examples of bullish and bearish candlestick reversal signals taken from the VectorVest tool. And the way our candlesticks look might be a little different than what you're used to, okay? But I'll go over them. I'll explain where the closes are, where the opens are. Highs and lows are easy to recognize no matter really what the candlestick looks like. But I'll go over that as well. So what we're going to talk about are short-term reversal signals. So candlesticks can be used to determine reversal patterns, reversal signals, or continuation chart patterns. We will here today focus on reversal patterns, okay? So here is what a candlestick looks like within the VectorVest program. Let's start with color first, because you see essentially two green candlesticks on your screen. One is a solid candle or a filled candle. That's the one on the right. And the other is an open or an unfilled candle. Let's talk about color and why they're green. If a candlestick is green, it means that the stock closed higher than the previous day's close. Okay, so green means it closed higher than the previous day's close. Okay. You have two different types of green candles. You have an unfilled green candle, which means the close of the day was higher than the open of the day. And you have a filled green candle, which means the close of the day was lower than the open of the day. Both closed higher than the previous day's close, but this one on the right closed lower than where it opened. This one on the left closed higher than where it opened. Easy way, I don't know if it's an easy way, but a way to understand this is what we do here and the way we explain it is think of it as a window shade. If I were to say to you, go to your window and pull down or close your window shade, what would you do? You would grab it from the top and you would pull it down and close it towards the bottom, towards the windowsill. So you can think of a filled candle or a solid candle the same way. right? Because the close is down here at the bottom, the open is up here at the top, and it resembles, I guess, maybe a closed window shade. You can't see through it, right? Or yeah, you can't see through it. And the one on the left, you can see through. So you opened it at the bottom, you grabbed it from the bottom, and you opened it up, and you let it go at the top, which gives you the opportunity to see through it. So that's the difference between unfilled and filled and green. Now, this chart has, this slide has similar, right? You have an unfilled or an open candle, and you have a filled or a closed candle, and they're both red. So they're red because both of these candles closed lower than the previous day's close. The same rules will apply for unfilled. Let me just do something here quick so you can see my mouse. The same rules apply for unfilled and filled here when they're red as they do when they were green. So a filled or a solid candle means the close was at the bottom of the body and the open was at the top of the body. And an unfilled candle means the close was at the top of the body and the open was at the bottom of the body. The body is the difference between the opening and closing prices, and the tails, or otherwise known as the wicks, are the highs and the lows. Okay, so this is going to be important, and I'm going to go through each example and explain it very thoroughly, because again, a lot of you probably aren't VectorVest subscribers. This may be the first that you're seeing this type of candlestick analysis. So those are individual candles. And let me go back, I'm sorry. You know, it's important to recognize where the stock closed compared to where it opened on both filled and unfilled and green and red candles, okay? This was a little bit more of an indecision. Both of these, I guess you would say, are indecision days, somewhat, because the close was very close to the open on both situations, and basically in the middle of the range. So while the bulls had a little bit more control on, let's say, this day, because they were able to close the stock higher than where it opened, and the bears had a little bit more control on this day because they were able to close the stock lower than where it opened. Still, again, closing near the middle of the range. Okay, so those are single candlesticks. And it says here, those single candlesticks convey valuable information about the changes in a market supply and demand balance. A succession of candlesticks taken together is more pertinent as they form a pattern. So that's what we're going to talk about today. We're going to talk about patterns. We're going to talk about two or more consecutive candlesticks which form a specific pattern. Okay, and we're going to first start off with Harami patterns. Okay, Harami, if you don't know, is a Japanese word that means pregnant woman. In a moment, you're going to understand why these particular patterns were named Haramis. Let's talk about what we want to look for first. We first want to look for a prevailing downtrend. Okay, this is a bullish pattern. We're first talking about a bullish Harami. So this is a pattern that you would analyze and identify so that you would potentially buy the stock. Okay, this is a bullish pattern. So what we're looking for here, if this is a bullish Harami and it's a reversal signal, so what do we need to be happening prior to the bullish Harami? If it's a reversal signal and we're going to look to buy this stock, we're going to look for a downtrend entering in or heading into the pattern. And I'm going to show you guys, I think, an easy way to recognize that, okay? So for you left brainers, right, who like to kind of read things and you understand concepts better when you read words, here, this is for you. I'm going to show you right brainers in a moment a chart that basically explains what we're seeing here now, okay? So first, it's a two-bar formation, two candlestick formation. So it says a filled red candle is observed on the first day. Okay, so it's a two-bar formation. A filled red candle is observed on the first day. The unfilled green body that is formed on the second day is completely engulfed by the body of the first day. So if you're trying to see what that looks like in your mind, go ahead, but I'm going to show you on a graph in a moment. And what I love about these reversal signals is they have baked in confirmation levels, buy levels, and baked in stop loss levels for each pattern. So the confirmation level for a bullish Harami is defined as either the last close, which is going to be the close of the unfilled green body. It's the last of two candles, right? It's a two-bar formation. So the confirmation level is defined as the last close, which is going to be the close of the unfilled green body, or the midpoint of the filled red body, whichever is higher. Prices should cross above this level for confirmation. Without confirmation, you have a failed pattern. Remember, I say remember, but I don't think I even mentioned this. Candlestick reversal signals identify changes in sentiment, changes in investor or trader sentiment. So without the confirmation, you don't truly have a change in sentiment, okay? And it's very important that you wait for the stock to confirm the pattern before trading it. And it says the stop loss level is defined as the lower of the last two lows. The lower of the last two lows. Okay, so what does this look like on a chart? It's a two-bar formation. Previous slide said the first bar is a filled red bar. What do we know about a filled red bar? Well, we know it's red, first off, because it closed lower than the previous day's close. We know it's filled or solid because it closed down at the bottom of the body and it opened at the top of the body. Okay? So this candle here reinforces you're in a downtrend. Okay, it kind of drives home the fact that the bears are in control here. The following day, the stock opens higher than the previous day's close, but closes higher than the previous day's open. The unfilled green body is completely engulfed by the previous filled red body. Okay, so this is a bearish Harami, and remember, earlier I said that Harami is a Japanese word for pregnant woman. Now my wife is not pregnant. We just had a 9-month-old. But I remember not too long ago that if I were to take my wife, and she's my wife so I can say this, and turn her to the side, this is kind of what she would look like, a pregnant woman. So the pattern looks like the silhouette of a pregnant woman, okay? And that's why in the 1700s, this pattern was called a Harami pattern, okay, because it resembles the silhouette of a pregnant woman. So here is so I've drawn on this chart the confirmation level, the buy level, and the stop loss level for this pattern. So don't worry about the date at the bottom. So June 28th at the close, you see that this is a Harami pattern. You're saying, okay, well, what do I know? Where's the confirmation level for the Harami pattern? It's the close of the unfilled green bars. So if price crosses above that level the following day, I could enter the trade. I have confirmation. If I do enter the trade, where is my initial stop loss? It's the lower of the two lows here. In this case, it's the lower of the low of the filled red candle here, the wick, the bottom wick of the filled red candle. That is the lower of the two prices here. Okay. Now, remember, the close, the buy level is either the close of the unfilled green bar or the midpoint of the filled red bar. And I know you could probably tell that the close of the unfilled green bar is a little bit higher than the midpoint of the filled red bar. Yes, Nick says, I thought if the candle was filled and the close was lower than the open of the same candle, it was. So here's a filled candle, right? Red, it means it closed down here and it opened up here. This is unfilled, meaning it closed up here and opened down here. Red, meaning it closed lower than the previous day's close. Green, meaning it closed higher than the previous day's close. So red color has to do with where the stock closed in relation to where it closed the day before. Filled or unfilled has to do with where the stock closed in relation to where it opened that day. Okay. All right, so here's an example, and I'm adding another layer here, guys. So before I said that when you analyze, when you're looking for a bullish Harami, or when you see a bullish Harami, you want the stock previously to have been in a downtrend. So clearly here, we're looking at AMAT, Applied Materials. Stock was in a downtrend. What I like to do is add another layer to it. I like to add the stochastics oscillator to it, okay? Because if a bullish Harami is supposed to identify a turning point, right? It identifies a change, a potential change in sentiment. I want to make sure that I have a much higher likelihood of a successful trade. So I added stochastics, and I look for stochastics to be below 20. Now, look, it doesn't mean that when stochastics is below 20, it doesn't mean the stock is going to turn on a dime, but upside potential outweighs future or further downside risk when the stochastics oscillator goes below 20. So knowing that risk reward profile there, using this indicator, if I identify a bullish Harami when the stochastics oscillator is below 20, I have more confidence that that's going to be a winning trade because, again, upside is more likely than future downside. In this case, what do we have? There's our bullish Harami. There's your filled red candle, reinforces that you're in a downtrend, and there's the stochastics below 20. The following day, well, look what happens. The stock rises and opens higher than the close of the filled red bar. That causes some concern for the short sellers, okay? They begin to cover their short trades, which does what to the price of the stock? It causes it to rise, right? You have other latecomers to the short parade that think they're getting a much better price than they would have gotten the day before. And they begin to short the stock thinking that there's going to be future downside. Well, what does that do to the price of the stock? That slows down the rise caused by all the short covering, forming your Harami. Okay, so that's kind of what's under the hood. It's a little bit about what is really going on there. What is believed to be happening between that bulls and bears battle that day. So you say, okay, you got a Harami here, great. Where's my confirmation level? My confirmation level is going to be the close of the unfilled green bar because that's clearly higher than the midpoint of the filled red bar. Say, great. If the following day the stock moves higher than my confirmation level, I enter the trade. And did it. Absolutely did. So you're in it. Where's your initial stop loss? Let's say you're wrong, right? Let's say that you get what's called whipsaw, right? Where the stock continues to move lower and you got a losing trade on your hands. Where are you going to cut your loss? Well, the beauty of these formations, guys, is the initial stop loss is already baked in. So it's the lower of the previous two lows, which in this case is the low of the unfilled green candle here. So you have a confirmation level, you get in, you have initial stop loss level. So let's talk about taking gains. Where would you look to take gains? Well, you may look to take gains at the most recent swing high, which is essentially resistance, right? Here, and I haven't talked about a bearish Harami yet, but that's the sister or cousin pattern to the bullish Harami, of course, is a bearish Harami. So you have a bearish Harami here at resistance. If a bullish Harami is meant to take action, right? It's meant to buy it. What do you think a bearish Harami is for? It's to help you take your gain off the table. So even though the stock kind of continued to move up a little bit, it broke down. And you know what? Good idea. Just take your gain off the table. You got a retracement off retracement from resistance. You got a bearish Harami. You may consider taking your gains off the table at that point. All right. Here's another example. We're looking at MCHP. So uptrend over, new downtrend, right? Stock's getting hammered here. Stochastics is below 20. That's key. There's my bullish Harami. Same pattern. Filled red candle reinforces that you're in a downtrend, but the following day the stock opens higher than the previous day's close, causing alarm for some short traders. They begin to cover. Newcomers, new short traders look to get a better price. That slows down the rise. You had a pretty tight battle there. So you look at that and you say, okay, I'm looking to enter the trade the next day if my confirmation level is met. And it was met the next day. In this case, the confirmation level was the midpoint of that filled red bar because it's higher than the close of the unfilled green bar. I enter the trade. Where's my initial stop loss? It's going to be the lower of the previous two lows, which in this case is the low of that green candle. Okay, stock actually fell the day after we bought it. Right, we bought it on this day here, the unfilled green candle, but it fell the following day. Did it fall enough to take us out of the trade? No, it continued to rise. Okay, so now where do you start thinking about taking gains off the table? Well, you could start thinking about taking gains at the most recent swing high. What we have here is another bearish reversal pattern called a bearish engulfing. Okay, so where is that bearish engulfing forming? Essentially at your the swing high. What do you also have here? You have stochastics above 80 as well, which indicates an overbought situation, which indicates more likely that the stock is going to at least take a little bit of breather or pull back from that level. And that might be an opportunity for you to take your gains off the table. Yeah, Nick says, can you use this for shorting stocks and other trading entities? Yeah, no, it's not only for buying, it's for shorting as well. Absolutely. So these bearish patterns, Nick, are when you would want to short the stock. Bearish patterns in an overbought situation, sure, you can use this. They're reversal signals. Okay, so we're absolutely. All right, so here is Broadridge. Broadridge Financial got a nice support level here, right? You got a couple of touches here, another touch here. Now you have your bullish Harami forming at a support level along with the stochastics oscillator below 20. Really not high probability trade here. Okay. What are we looking for? We need confirmation. Confirmation level. We know it's either the close of the unfilled green bar or the midpoint of the filled red bar, whichever is higher. In this case, it is the close of the unfilled green bar. Great. Did we get confirmation the next day? We sure did. Got a nice support retracement there as well. You got your initial stop loss. Look, just a little tip here. You have a really strong support level here, right? Right, and we talked about support and resistance, I think, in a previous webcast. Your initial stop loss level for this pattern is essentially right at support. It's actually a little higher than support. What I would do is I would probably use support as my initial stop loss, okay? Because you're so close to it, right? You don't want to just have the stock just go below your initial reversal signal stop loss and then have it stay above support and continue to move higher. It would make sense if you're that close to support, just use support as your initial stop loss, because as you could see, stock had a hard time breaking through that level. You hope that that continues, and it did. Okay, so now you got a level of resistance here so now let's talk about when are we going to consider start taking gains. Got a nice gain here. Got a nice gain here. You got, I don't know how many points, 115, you got 120, almost 5 points here. Okay, so now you have a bearish Harami. It's a bearish reversal signal at resistance with a little bit of a pullback. You know, the choice is always up to you guys. I'm just giving you some guidelines here on what to look for if you got a nice gain and where you want to consider taking gains off the table. The decision is ultimately up to you. You could take half off if you wanted to and let the rest run. But here are some signals. Here are some indications. All right, last bullish Harami here. Very similar. So this is TER, stochastics below 20. There's your downtrend. There's your bullish Harami. That indicates a potential reversal. We don't have a reversal yet until we get confirmation. Confirmation level is the close of the unfilled green bar or the midpoint of the filled red bar. We got confirmation the following day. Our initial stop loss was not taken out. So we got another nice trade on our hands. And if we look all the way up there, so what happened here? The stock rose nicely, right? Right? It rose, and where did it stop on this day? It looks like a hammer, but it's called a hangman. Where did it stop? Exactly the same level that it stopped back here. So you may think, oh, well, you know what? Okay. If it retraces tomorrow, if it retraces from that level, I'm out. I got a really nice gain here. No need to squeeze out every penny. But what happened? It gapped up the following day and continued to move higher, allowing you to stay in the trade. Now we have a true reversal signal with ensuing confirmation, which would be, your run for the hills type of let me move on to the next trade. Okay. Here is a pattern called a one black crow. It's another bearish formation. As you can see, That identified the top there, or that turning point. That was all she wrote after that one black crow formation. Okay, here's another bullish Harami, also at a support level. So here, where's the confirmation level? Is it the close of the unfilled green bar, or is it the midpoint of the filled red bar? It's the midpoint of the filled red bar because that's higher. There's our initial stop loss. Same situation here. I would suggest just using support in this case because your initial stop loss with this pattern is so close to support. There's resistance. What is that? That's a bearish Harami. Good opportunity to take your gains off the table. All right, I thought it was the last one. Here's another bullish Harami. Fantastic. You got really strong support and resistance here. You have the bullish Harami forming at support. Okay. You also have stochastics below 20. You got a lot going for you here with this trade. There's your confirmation level. You wait for the stock to cross above that confirmation level for confirmation, or for a trigger, and you got it the next day. I know it closed below your confirmation level, but it went higher during the day, which may have resulted in you entering the trade. Initial stop loss basically right at support. What happened here? Stock, we entered, the stock went down, it kind of moved sideways. Oh my God, it opened all the way down here on this day, kind of moved a little bit lower on that day, but it did not take us out, and we were able to stay in the trade. And then once it retraced from resistance, we exit. Nick says, does this work only on daily charts? You can use this on time frames, intraday as well. Intraday as well. I use them on 5-minute bars. A lot better than 1-minute bars, I think, because 1-minute bars is a lot of noise there. So if you can use them on intraday charts as well. Whichever time frame you want to look at, they work. They apply. Okay. So what do you have up here? And I'm pointing this out too, because you have a few bearish formations here right at resistance, and you can see what that led to. And over here at support once again is another bullish Harami, which you could see indicated that turning point. There's our confirmation level. There's our initial stop loss level. Did we have a chance to make money there? Absolutely. Okay, so let's talk about the bearish Harami. Okay, it's a bearish pattern. It just, and I showed you a few examples, but let's look at these exclusively now. So if it's a bearish reversal signal, what do we need the stock to be doing, or the market to be doing prior to that pattern? We need it to be going up. So we look for the market, it says categorized by a prevailing uptrend, and you're basically flipping the methodology over. An unfilled green body is observed on the first day. The filled red body that is formed on the second day is completely engulfed by the body of the first day. The confirmation level is defined as the last close, which is always going to be the close of the filled red body, or the midpoint of the unfilled green body, whichever is lower in this case. Because this is a bearish pattern, we expect downside pressure in the days that follow. Prices should cross below this level for confirmation, and the stop loss level is defined as the higher of the last two highs. Here's what it looks like. Very similar, but you just got a different perspective. Now you're in an uptrend, and this unfilled green candle, which closed at the top of the body, and here's what it opened, this reinforces that you're in an uptrend. The next day, the stock opens here, lower than the previous day's close, and that causes concern for the buyers, for bulls. They take their gains off the table. They start selling their positions, which causes the stock price to fall. Now you have latecomers, late bulls, that think because the stock opened lower than the previous day's close, they're getting a better price, and they start picking up shares, which slows down the fall. Okay, so the confirmation level is either the close of the unfilled red bar or the midpoint of the filled green bar, whichever is lower. In this case, it's the close of the filled red bar. Your initial stop loss is the higher of the previous two highs. Obviously, it's the high here of the unfilled green bar. So let's take a look at some examples. There's your bearish Harami. Here's your uptrend. There's your stochastics above 80. Okay, kind of expecting a turning point, right? So there's your confirmation level. There's your initial stop loss level. Our confirmation was hit the next day, and the stock didn't really go in our direction for the following 4 days or so. But was our initial stop loss triggered? It was not, even with the stock rising there for a few days. Okay, The pattern held, the stock continued to move lower. We had an opportunity for some gains. What's all the way down here? Why do I point that out? Well, I point it out because it's a reversal, right? And what did we see at that bottom? What did we see at that reversal? We saw a bullish Harami. Remember, we just looked at them. Okay. Here's another bearish Harami. Here's your uptrend, right? Not a very strong uptrend, but it's enough to cause the stochastics oscillator to go above 80. There's your bearish Harami. There's your confirmation level. There's your initial stop loss level. We had an opportunity here for some quick gains. This is called a hammer. Okay, that's a bullish pattern. Why do I point that out? Because a hammer is also a reversal signal. And where was the reversal? Right at the hammer. Okay, here we got a couple of patterns. Here's your bearish Harami. There's your uptrend, really strong uptrend, right? Really strong uptrend. You're making some nice gains. You got a nice unrealized gain in your portfolio, and then you see this big filled red candle on the following day. That forms your bearish Harami. We got confirmation the following day. So if you are long this trade, you may want to consider exiting if you get confirmation. So what happened the following day? Actually, look at where the stock opened. So here's your bearish Harami. The unfilled green body, filled red body, there's your bearish Harami, there's your confirmation level. The stock opened all the way up here the following day. But during the session, it fell below your confirmation level. It actually closed near the low of the session, uptrend over. Okay, there's your initial stop loss if you do decide to take this trade short. And if you did decide to take this trade short, where would you may consider taking gains off the table? Well, stock falls, you got a nice unrealized gain, stochastics goes below 20. Now you start paying more attention when stochastics goes below 20. You observe that you got a bullish Harami here. Whoops, sorry. Confirmation the following day, you're out of your short trade. You can flip it over and, this is fact set, interesting. Flip it over and then buy the stock again. Okay, you got a really strong level of resistance here. There's your bearish Harami. There's your confirmation level. There's your initial stop loss level, a little bit above resistance. Just because you get the pattern doesn't mean you take the trade. You take the trade the following day. If you get confirmation the following day, the stock actually opened higher than your confirmation level, but during the day fell below it, causing you to either exit a long trade if you were truly waiting for a resistance retracement, or just simply a confirmation of a bearish reversal signal. You're out of your long position, you could take on the short position. That's called a Dragonfly Doji Bullish Harami. It's also called a Harami cross because it's a Harami, right? You got the opening and closing prices of this doji here it completely engulfed, right, by the filled red body. It's a Harami, but it's also a Dragonfly Doji, and you get confirmation on the following day. You take your short trade off. Here's a gravestone doji with a stochastics oscillator below 20, reversal pattern, reversal signal only if upside confirmation is received the next day, and you can see we did. Okay, so those were bullish and bearish Haramis. I know I threw a lot at you guys, but you know, you're going to get this recording, so you'll be able to watch it again and again and again, because just once, I don't think, you know, he's going to cut it. Obviously, you know, this might be something new for you, so you can watch it over and over. Let's talk about two more. All right, these are the last two that we'll talk about: white soldiers and black crows. A white soldier, or also known as a one white soldier, is the bullish pattern, and a one black crow is the bearish pattern. So let's talk about the bullish pattern first. One white soldier. It's bullish, so we expect a change in direction, meaning that the stock is going to stop going down and start to come back up. So we need a downtrend prior to the one white soldier pattern. So it's a 2-bar formation, and the first bar is a filled red candle. We know what that means, right? Filled red candle. It means that it's red. It closed lower than the previous day's close, reinforcing that you're in a bearish environment. And it's filled because it closed lower than the open, which means that the bears won that day. Okay, they overpowered the bulls, not only on a close-to-close basis, but on the open-to-close basis as well. So a filled red candle is observed on the first day. Whoops, not even close to being done. The unfilled green body that is formed on the second day, here we go, opens higher than the prior day's close and closes higher than the prior day's open. Confirmation level is defined as the last close. It's always going to be the close of the unfilled green body. That's always going to be your confirmation. Prices should cross above this level for confirmation. If they don't, you don't take the trade. And the stop loss level is defined as the last low, always going to be the low of the unfilled green body. Here's what it looks like. There's your filled red candle, close lower than the previous day's close, also close lower than the open, reinforces you're in a bearish mood. The next day, the stock opens higher than the previous day's close. Very similar to the Harami, right? However, the stock closes higher than the previous day's open. It doesn't close lower than the previous day's open. That would have been a Harami. This is a one white soldier, so it closed higher than the previous day's open. Okay? This is a reversal signal. When the stock opens higher than the previous day's close, that causes concern for short traders. When they begin to cover their short positions, it causes the stock price to rise. But in this case, we didn't have a lot of latecomers, late short traders coming in thinking that they're getting a better price. If that were the case, the rise would have been slowed down by more short trading. But that didn't happen because the stock closed way up here. Short covering along with buying caused the stock price to close above the open of the previous day, forming the one white soldier. There's the buy level. There's your confirmation level. Always going to be the close of the unfilled green bar. Stop loss level is always going to be the low of the unfilled green bar, not the lower of the previous two lows like the Harami. Okay, there's your one white soldier, right? Strong downtrend. Boy, the stock crashed for a couple of weeks there. Stochastics well below 20. Then what happens on that green day? You got a stock that opens higher than the previous day's close. That hadn't happened for a while, right? That hadn't happened for a while. So there's something up there. You got a lot of short traders covering their positions. What does that do? It causes the stock price to rise. It's hard to tell just by looking at this what truly happened this day. Was it all short covering, or was it a combination of short covering and buying long to open? Initiating new, not buying to cover, buying to open. Was it a combination of both of those that caused the stock to close all the way up here? Hard to know that looking at this chart. Nevertheless, where's our confirmation level? Where's our initial stop loss level? We know that, guys, going in, right? We know that going in. Before you even enter the trade, you know when you're going to get in, you know when you're going to get out. Okay, what happened the following day? We got our confirmation. Fantastic. We're in the trade, and then the stock falls for the next couple of days. Saying, okay, I don't know, but you do know that you're going to exit if your initial stop loss is triggered. Simple. It doesn't. It's not triggered. The stock goes up. You got a nice winning trade on your hands. Let's look back here at this turning point, because I want you to have confidence in these signals. And you'll only have confidence if you see them multiple times. So a gravestone doji is where the opening and closing prices are near the low of the session. You got this really long upper wick, which means that buyers had control for most of the session. However, they lost control and sellers dominated the close, closing it down here. That has bearish implications if you get follow through the next day. If that selling pressure that occurred during the trading session the previous day, if that trickles over to the following day, especially if you're in an overbought situation, that could lead to some downside pressure. Okay, so another turning point. Do we have a bearish pattern at that high there? We do. It's called a bearish engulfing. Okay, and that was all she wrote on that uptrend. Okay, here's your one white soldier again. There's your downtrend. There's your filled red candle there, closing well off of the high of the session and closer to the low. Doesn't have to be a huge filled red candle, guys. Okay, filled red candle, stochastics below 20, higher open the following day, right? And a higher close than the previous day's open. There's your one white soldier. Filled red bar, unfilled green bar. There's your one white soldier. Confirmation level is the close of the unfilled green bar. Initial stop loss is the low of the unfilled green bar. What happens the following day? The stock actually opens lower, right? Okay, let's look at these three candles. Filled red, unfilled green, unfilled green. The unfilled green, the second unfilled green, is your confirmation candle, but it didn't open above your confirmation level, okay? But it did cross above that confirmation level during the day, resulting in your trade being executed, okay? Stock opened, gapped up the next day, but it fell, crashed during the day, but stayed above our initial stop loss, allowing us to stay in the trade. Remember the bearish Harami that we just talked about. So here's another bearish Harami right here. So what happened here? The stock confirmed the following day. Confirmed the following day, right? And then went up for the next 2 days, but it never triggered a stop loss. Here's another one white soldier. Okay, doesn't look like much of a downtrend, right? It's actually not really a downtrend. It's just a pullback within an underlying uptrend. But the pullback was strong enough to cause stochastics to go below 20. Okay, there's our one white soldier. There's our confirmation level. Same situation here. The stock opened below our confirmation level, but during the day crossed above it, resulting in the trade being taken. Okay, initial stop loss was not triggered, and off she goes, and good opportunity for some gains there. Okay, so here was what I put here was a bearish engulfing, but it was unconfirmed. That's what that means. Here's your bearish engulfing. Stochastics above 80. So now if you're in this trade, what do you look to do? The following day, you look to exit the trade, potentially, if the bearish engulfing is confirmed. And it was not. It was not confirmed. The stock continued to move higher, allowing you to stay in the trade. Here's what's called a dark cloud cover. This is another bearish formation. Saying, okay, man, 2 bearish formations in a row. I'm prepared to exit. You wait for the dark cloud to be confirmed on the following day, and it was not, allowing you to stay in the trade. Now here is where you have a confirmed bearish engulfing, because as you can see what happened with price action the following day, it confirmed the bearish pattern. Confirmation, very important, very important. Don't just exit the trade maybe near the close of a session because you think it's going to form as a bearish Harami. Okay, without confirmation, you got to wait for confirmation. Okay, here's your one white soldier, right? Here's your downtrend. There's your new closing low with the filled red bar, stochastics below 20. There's our confirmation level. There's our initial stop loss. We got our confirmation the next day. Where may we look to take gains off the table? Well, stochastics goes below 80. Above 80, and we see a bearish Harami. Right? See a bearish Harami. Do we get confirmation the next day? We sure do. Okay. So you may look to take the gain off the table there. Okay. That's called a shooting star. So why am I pointing this one out? Because it's a turning point. It's a reversal. Shooting star is a reversal signal. And that was all she wrote, right? End of that up move and the beginning of a new down move. So shooting star, stock opens here at the top of the body, right? Because it's filled. It opens at the top of the body and skyrockets much higher throughout the session. Bulls give up. They take their gain off the table. Short sellers might come in and think they got some nice downside, and look at what that does. Causes the stock to crash, closing well off of the session high, near the session low, which that action, that price action has bearish implications if you begin to get follow through on the coming days. And we took a couple of days, okay? Took a couple of days, but the high of that shooting star was not met, nor was it broken. It stayed below, and then again, new downtrend started. Here's another one white soldier. Okay, so here's your downtrend. There's the stochastics below 20. Big up day, big strong up day. A lot of short covering that day, a lot of buying potentially. There's our confirmation level. There's our initial stop. We got our confirmation the next day. Downtrend over, reversal underway. And where maybe we look to take gains off the table. Again, I'm always going to point at these major reversals, guys, because in my experience, you see, I would say more times than not, I can't put an exact percentage on it, but more times than not, when you see these major reversals or these considerable turning points, you're going to see a bullish or bearish pattern. Okay, so start looking at those at some of these things. Moving forward. Here's a bullish Harami. There's a bullish engulfing. Turning point, retracement, bullish Harami. Where is it forming? Not only is stochastics below 20, but it's forming at a level of support as well. Really strong signal at that point. And then you got your nice support retracement. All right, we got a couple here. Bearish engulfing. Okay. Selling pressure followed. What's that? That's our one white soldier, right? One white soldier, downtrend or more so a retracement within an underlying uptrend. But again, retracement strong enough to cause stochastics to go below 20. You got your really strong, kind of inflection point here, right? Confirmation level was reached the next day. Our initial stop loss was not. Where do we look to take gains off the table? You got two bearish patterns there. Why do I point to those 2 points or patterns? Because look at where stochastics is, well above 80, right? So two bearish patterns here. Point I want to make here is that gives you two opportunities to exit the trade. There's our bullish Harami cross, stochastics below 20. Nice opportunity for gains there. All right, last one, one black crow. It's the sister pattern of the one white soldier. So it's bearish, which means that we want the stock to have been rising prior to that bearish pattern. An unfilled green candle is observed on the first day. The filled red body that is formed on the second day opens lower than the first day's close and closes lower than the first day's open. Confirmation level is defined as the last close. It's always going to be the close of the filled red body. And the stop loss is defined as the last high, always going to be the high of the filled red body. Here's what it looks like. Unfilled green candle on the first day reinforces that you're in a bullish environment. The stock opens lower the next day than the previous day's close. That causes some concern for the bulls that have nice unrealized gains in their positions. They start to sell. Taking the gains off the table. What does that do to the stock price? Causes it to fall. And in this case, we don't have a lot of late bulls, right? A lot of late buyers. They believe that the trend is over, and they don't start picking up more shares, which does not slow down the fall of price, right? So big bearish day today. You got to think that, a trend change is imminent, and it's only imminent, or the trend change is only underway if you get that confirmation level, the confirmation the next day. So if your confirmation level is broken the following day, you might consider exiting your long position and or taking the short position. Initial stop loss is always going to be the wick, the high of the filled red bar. All right, so let's look at this hammer first. Okay, here's a hammer right at support. Remember, the hammer is a bullish reversal signal. We got a nice follow through the next day. And what do we have here? Well, first off, the previous day, it's called a spinning top. This mini filled red candle where the the opening and closing prices are within, kind of right in the middle of the range. That's called a spinning top. That is an indecision day in general. And then what happens? You start to see some weakness on the following days. But this right here is that one black crow. So we have to look at that pattern and know where our confirmation level is. Where should I exit my long trade? Where should I consider exiting my long trade if I bought it down here? You may want to consider exiting when you see a one black crow confirmed, and you see there that it was confirmed on the following day and on the following next couple of days, right? Back here was a shooting star that was unconfirmed. Stock went higher the next day, went a little higher the next day, but you had that's a doji. That's another day of indecision. So a bearish pattern called a shooting star when stochastics went above 80, however, not confirmed. Following day, a real battle between buyers and sellers, causing this doji representing indecision. Stochastics still above 80. Something's got to give, you would think. And what happens on that next day? The stock crashes. Sellers win. Bears win. Okay. All right. Here's a bearish pattern called a hanging man. It's in the shape of a hammer. It looks like a hammer, right? But this one occurs at the top, right, or the end of an uptrend. All right. So what are we seeing here? We see a stock that opens up here, and then sellers, boy, did they dominate trading. They pushed the stock price all the way down here, but they gave up, and the buyers came in, or some short covering, and caused the stock to close well off of the low, but nearer to the high of the session. It has bearish implications because you cannot ignore the fact that sellers were able to, during the trading session, push the stock price all the way down there. That's why you wait for confirmation. Did that early selling pressure trickle over into the next day? And if it does, you're likely to have a reversal at that point. And we did. Where did the stock stop, right? It stopped here. This is called a piercing pattern, a bullish piercing pattern. We didn't talk about it today, but it's another bullish formation. Stochastics below 20, you got your reversal. There's another hanging man. Back-to-back bearish formations, hanging man and shooting star. Did the stock continue to go up after that? No, it broke down a little bit, resulting in some weakness there. There's our one black crow. So not only is it a one black crow, not only is stochastics above 80, but where is it forming? Right at resistance, right at the same level that you had your hanging man and shooting star form, back here a month prior. And it just was, the bears just were stronger, right? Selling pressure overcame buying pressure. The bulls have tried. They've tried on multiple occasions, but they just couldn't do it. They just couldn't push the stock price any higher, and the bears finally won over, and boy, did the stock crash. Are you starting to understand a little bit better, guys, the psychology here, right? Really what's going on under the hood, really what's going on in the head of these traders and the majority of traders at these points, okay? Really important. That's what candlesticks do. And if you study them enough, this stuff's going to become second nature to you. All right. So here's our confirmation level initial stop loss. Boy, stock crashed, right? Stochastics went below 20. Here's our one white soldier. And that was the end. Look, I'm sorry. That was the end of the downtrend. Okay. All right. There's our one black crow at the top there. Stochastics above 80. One black crow confirmation was met the following day, during the day, right? It opened, here's where it opened. It's a filled green candle, so we know it's filled, meaning it opened at the top of the body. So it didn't open below our confirmation level, but it went below our confirmation level during the day, and it actually closed above our confirmation level. That's not going to cause us to exit the trade though, right? Why? Because we know when we're going to exit the trade, okay? If it crosses above the initial stop loss. Now, it's hard to know, guys, what happened first, the high or the low of the day, Okay, so I don't know if the stock opened here, went higher during the session and then fell, or opened at the top of the body, went lower, went higher during the session, and eventually closed down below. Hard to tell, but as you can see, that was the end of the uptrend for sure. All right, here's another hanging man right at that turning point. There's a bullish engulfing, all right, at that turning point. There's a shooting star that caused a little bit of a hesitation, right? And if you're in a trade, right, if you took the bullish engulfing trade and you see a shooting star as strong as that one, where the sellers took control and closed the stock near the low, if you got a nice unrealized gain and you see weakness on the following day, if you stay in the trade, that means you're trying to squeeze out every last penny, right? You think that the stock is going to continue to go up. Don't think. Read the chart. Read the chart. What is the chart telling you? Chart is telling you that look at where the shooting star stopped. Same level, right? Right at resistance. Read the chart, and traders really make decisions based on the factual information that's going on here, not what you think is going to happen moving forward. All right, there's your one black crow. There's your confirmation level. There's your initial stop loss, end of the uptrend, and beginning of new weakness here. Okay, there's your bullish Harami. There's your piercing pattern. All right, so you got a little double, I would call it a double bottom, but because it's not really a bottom, but it's support. You got a nice support level that's being established here with one bullish pattern, two bullish patterns. Neither trade. Look, you maybe had an opportunity for some gains here, but it's hard here because I don't really see a bearish pattern. But where would you think about taking gain off the table here with this piercing pattern? There's your one black crow. Again, resistance there, and stochastics above 80 as well. There's your confirmation level. There's your initial stop. You can have reversed that trade, that bullish piercing pattern trade, closed it, opened a short trade based on the one black crow, rode that baby down, bullish Harami, and there you go. All right, guys. I enjoyed today. I love talking about candlestick reversal signals. I trade them myself. I love them, love them, love them. And again, I hope that was just the beginning of a series here. You know, there's plenty of other patterns that we can teach you, and you know, we'll look to do that. Tony says so much new but very interesting stuff. I'll watch the video again and again. Thanks so much, Jerry. You're welcome, Tony. So you're welcome, everybody. Look, if you have any more questions about anything that we've talked about, my contact information is jerryd@vectorvest.com. The tool that I used in the program and the charts that you saw there are from the VectorVest program. You can go to www.vectorvest.com for more information on the VectorVest tool. But again, if you have any questions, just please shoot me an email. Okay, shoot me an email. And again, if you want to learn more about the VectorVest tool, you could shoot me an email as well. All right, guys, I'm going to turn things over to Cynthia, and she's going to close for the day. And I look forward to talking to you guys again in the future.
Well, Jerry, thank you so much. Terrific information and jam-packed with some ideas. So with that, though, we are going to conclude our session today. I do want to thank Jerry D'Ambrosio and VectorVest for today's presentation, and also do want to remind you that we have been recording today's event, and each of you will get a direct link to today's recorded playback soon after the session ends. So if you do want to come back and review the concepts that Jerry discussed, simply watch your email later on today, and I will be sending out those follow-up messages. Normally takes about an hour after we end the session, so watch your inbox, everyone. All right, with that, we are going to conclude the session. I'm actually going to bring up on my screen the contact information if you're looking for more about working with VectorVest and Interactive Brokers. So with that, we are going to conclude our session today. Thanks, everyone, for your participation, and you can use the X in the upper right-hand corner of the screen. Thanks, all. Have a great rest of your day.